If we don't cover, once we've covered the entire session, I may go back and look through the chat, but please try and use the Q&A and we'll answer those questions as we go through the webinar. If you're joining us live on social media, you can post your questions on the post, and we will have a colleague transfer those over to us live here and do our best to answer them live. If we miss them, then we'll go back through the post and answer them at a later time. So today's session is specifically focused on source deductions. And what we're talking about specifically are source deductions for owner-managed businesses, and particularly helping those like our clients who are doing salary on an annual basis rather than on a monthly basis. So without further ado, my name is Andrew Wall, and I'm the managing partner here at CPA4IT. Our mission at CPA4IT is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We are specializing in independent contractors and service-based businesses. And today's session, we'll be talking about payroll source deductions. We'll be talking about what those actually are, how to calculate your remittance amount, the different types of remitter types that are available, and the appropriate due dates according to the type of remitter you are, the different remitting methods, as well as how to correct any remitting errors if you've over or under remitted, and then lastly, how we can help. So let's start with what exactly are payroll source deductions. So payroll source deductions are the amount of money that is withheld from the employee's paycheck by the employer and remitted to the government on behalf of the employee to pay their CPP, income tax, and EI if applicable. So this would also include both the employer and the employee's share of the CPP and EI, again, if EI is applicable. So remittances are the amount of money that are paid by the employer to the government. And these remittances are deemed to have been made on the day it's received by the CRA. So it's not the date that you log into your bank and you issue the payment. It's the date the CRA receives it. That's an important thing to note because typically it does take 1 business day for a payment to process. So if you process a payment on the 10th through your bank, it won't clear till the 11th. So you really need to make sure that you're using the appropriate remittance method to meet your due date. Now, the CRA submission is separate from the actual remittance amount. Although when you do your payment through either the CRA website or through your online banking, you'll typically do that through a PD7A form, which will include both the remittance amount that will be processed as well as the CRA submission itself. So these forms are a necessary part of the process. The due dates for completing these forms and these remittances we will talk about in more detail as we get into the different types of remitters because it can get a little bit complicated. But before we get into those remitter types, let's figure out whether you need to even do any source deduction planning right now. So if you are new to independent contracting and this is your first year and you've had a corporation throughout the year, you may wish to declare a salary from your corporation. And if you haven't been doing that on a monthly basis, the last day that you can declare a salary is December 31st. And you would need to make a remittance by early January. And we'll talk about those deadlines, as I said, in a second. This is important to note because if you're even a day late, there are significant penalties. It's one of the highest penalties. And again, we'll talk about those in more detail. Now, if you're planning to account for the money you've withdrawn from your corporation as a dividend, dividends don't have a source deduction associated with them. There's no money withheld from a dividend and remitted to the government on behalf of the shareholder. So if you're planning to do dividends, you probably don't need to worry about any source deduction planning right now. In addition, if you were working as an employee prior to setting up your corporation and you have a large amount of income from employment prior to setting up your corporation, you probably don't want to declare any salary from your corporation. Now, even if your company earned income during this calendar year and you withdrew money from this calendar year, that doesn't mean you have to declare salary from your corporation, because the salary that you declare from your corporation can be declared anytime throughout your fiscal year end, and up to 6 months after your year end. So let's say that you have a July 31st year end. So you incorporated, let's say in early August, and you set up a July 31st fiscal year end, and you earned income from August through to December, but you had income from employment all the way up until that contract in August. So you may not want to declare any of the money you've taken out of your corporation from August through to December until the next fiscal year, until 2025, and you will have that option. And in fact, if you have a July year end, and let's say it's a July 31st, 2025 fiscal year end, you have the option of declaring salary anytime from August 1st till December 31st. You also have the option to declare salary from January 1st, 2025 till July 31st, 2025. And in fact, 6 months from then would push you all the way until January of 2026. So if you had a July 31st, 2025 fiscal year end, you would have the option of declaring salary in either 2024, 2025, or even 2026. Now, again, if this is all getting overwhelming and confusing and it's your first year, we do encourage you to reach out and connect with your account manager here at CPA4IT. But for those of you who have some familiarity with this process or have been doing independent contracting for a couple of years, we've developed some processes to make this a little bit faster and easier for you, so you don't have to go and book a meeting with your account manager. And what we're going to do is go through a bunch of questions with you to determine how much we should declare as salary. And that's going to be done through some of our online forms, which we'll share with you already. Now, in addition, if this is your second, third, or fourth year as an independent contractor, and you have already declared salary for 2024 with your account manager during your annual tax planning, you may not need to do any additional tax planning. Now, it is possible, again, that you may want to increase the amount that you declared at your year-end review meeting. Let's say that you had, a January 31st year end, and you just declared enough to cover the amount of money you'd taken up till January, and you want to increase your annual personal salary. We'd need to do that before December 31st. And if your year end is January, by the time we sit down to do your planning again, it may be too late. So in that situation, you might also want to go through this planning to figure out how much we should declare as salary for you during the 2024 calendar year end. So in going through that process, there's a couple things that we're going to look at. So how much money have you withdrawn since your last corporate year end? And that's sort of the most important factor, because we have rules when we're dealing with your corporation that tell us that if you're taking money out of your corporation, that barring a couple of tricks up our sleeves, that's going to need to become either a salary or a dividend. Now, there are always tricks up our sleeves. So if you're struggling and you've got a unique situation, again, reach out and speak with your account manager. But we'll also want to know how much money you either have or will contribute to your RSPs, because RSPs will reduce the taxable income. So that's helpful for us during your tax planning. We'll also want to know if you have a target net income. So if you are trying to buy a home, that many of you may be aware that the banks are going to want to look at 2 years of notice of assessment. And so your ability to purchase a certain priced home might require you to have a larger income than what we would normally target. And what I can tell you is typically as your accountants, our goal is to pay you as little money as possible from the corporation, because the personal tax rates are substantially higher than the corporate tax rates. So one of our goals is to keep as much money inside your corporation as possible and pay you as low a salary as possible, which is why we base a lot of it on how much money you've withdrawn from your corporation. However, like I said, if you are looking to buy a home or there might be other circumstances going on where you want to have a specific target net income, it's helpful for us to know that as well. We also want to know if you have any family members that you can do any income splitting with. Those could be children, spouses, parents, or anyone that we're looking to do any income splitting with. This is important again because with the marginal tax system, if we have two individuals both earning $50,000, they will pay less cumulative tax than one individual taking $100,000. So to the extent that we can smooth income amongst family members, that's great. We do have specific rules with family members that they have to pass a reasonableness test that the salary is reasonable for the work that they've done. We do also recommend that you keep a job description and timesheets, as well as if it's a child or a parent, we see the flow of funds going from the corporation to that person's bank account. With a spouse, it's not as important because the CRA will recognize that you work together as a couple. So we have a little bit more flexibility there. The other thing we're going to want to know is if you were planning to take any of this income as dividends. Now, what I would tell you when it comes to tax planning, I get asked this question all the time: should we do a split with salary and dividends? And what I can tell you when it comes to tax planning is it's a bit of an art form, and there's no right or wrong. But my personal belief is to never split between salary and dividends. Commit to whatever strategy that you're going with. The salary, in my opinion, is the best strategy while you're earning income. It's going to be eligible for RSP room. It's going to be eligible for CPP contributions. Two strategies that we do recommend for retirement planning. Now, if you don't value CPP and you don't value RRSPs, which some people have their own perspectives on that and don't appreciate them the way we do, then go all in on dividends. There's no point in splitting it and paying some CPP and getting some RSP room, but not the full maximum. Commit to whatever strategy you're going with is the one thing I would highly recommend. Now that we figured out whether we need to do any tax planning and what questions we need to ask, we need to figure out, okay, well, if I'm paying source deductions based on the planning that I've done now with my account manager and the amounts that they've told me, when do I have to pay this by? What I will tell you is we are always going to tell you to pay by the earliest possible date, which if you're doing a December 31st payroll, that would be due by January 3rd. Now, there are different types, and these remittent due dates are going to be based on the remitter type that you are, as well as when you paid the employee. Now, what can get really confusing if you have been an independent contractor for more than a year is you might get letters from CRA saying, hey, you need to pay us monthly. Where's your remittance? And you are a monthly remitter. Most of you. There is a quarterly remitter type, which we'll talk about in a second, but most of you are monthly remitters. However, you have no employees with any eligible remittances for any month other than this month or your fiscal year end, depending upon your unique situation. And there is a form that you can submit to CRA, which is the PD7A, where you can tell them, I have no employees with any eligible remittances, and I don't expect to have any remittances until next December. So typically for our clients who are doing annual bonuses as opposed to monthly payroll, what you would do is make your remittance by your deadline, and then next month complete another PD7A form saying I have no employees with any eligible remittances, and I don't expect to have any employees with eligible remittances until next December. But from CRA's perspective, the payroll remittance is always going to be due based on when the payroll is paid. And what you have to remember is if you are using our strategy where you're withdrawing money from your corporation and considering it a loan, that's not payroll. And that's why we say don't take the same amount every single month, because CRA might consider that payroll, and then they'll want you to make payroll remittances every single month. But if you're taking money as you need it from the corporation, we can consider that a loan. And then loan at the end of the year is closed out with a salary declaration or a dividend declaration that is done as part of your annual minutes. And then your remittance due date would be a function of the date we declare that salary, which in this case would be December 31st, and then would be due by what we're going to tell you is January 3rd, but you'll see in a second that it could be the 3rd, the 10th, or the 15th. If your due date does fall on a weekend or a public holiday, you will have till the next business day for your remittance. However, if your business goes bankrupt or stops operating, you must remit your deductions to CRA within 7 days following the closure of your business. So if anyone's planning to dissolve their corporation, that's an important thing to be aware of. Now, typically when we do a dissolution, there's usually not funds to be declared as salary, but if there is, it's important to note that that is going to be due sooner than normal. Now, to figure out what your true deadline is, we need to determine what type of remitter that you are. And there's a regular remitter, a threshold 1, a threshold 2, and a quarterly remitter. Now, how CRA determines what type of remitter you are is a little bit complicated because it's based on something called your average monthly withholding amount. And to make it even more complicated, it's based on your average monthly withholding amount from 2 calendar years ago. So that can be very, very confusing for many people, which is why we do always err on the side of caution and give you the most conservative deadline, which is going to be due on the 3rd of the month. So the average monthly withholding amount, if you were doing monthly payroll, would be take your 12 months, total them up and divide by 12. Now, if you're only doing your payroll remittance once a year, whatever your remittance was 2 years ago will be your average monthly withholding amount. So now looking at that understanding of how they determine what type of remitter amount, you can see that the default is a regular remitter. And in fact, for your first 2 years, because it's based from 2 years ago, you will be considered a regular remitter, and you'll actually have until the 15th of the following month in which you've made your payroll remittance. So it would be by January 15th. Now, if your average monthly withholding amount is more than $25,000, but less than $100,000, you're a threshold 1, and it's going to be due on the 10th of the month or the 10th of January. Now, as I said earlier, we always tell people we err on the side of caution. We assume that you'll be a threshold 2, which is an average monthly withholding amount of more than $100,000. Very few of our clients do fall into this range, but we always give you this deadline to be conservative. And so this will be due by the 3rd, and this is why you'll see all of our communication is telling you to pay by the 3rd. It's better to pay by the 3rd, even if it's not due until the 15th. And I can see we've got our first question coming up, so let me take a look at that. Hey, great session. I have specific questions regarding this topic. What is the best way to hold of you? I did send in a question using Lisio to a previous session, and it sent it to Andrew Wall, but I did not get a response. Should I book a 15-minute meeting in calendar? Yes, Joe, you should. So I'll look into why my EA did not escalate that up to me. The reality is that usually most of you have an account manager. You should go directly to your account manager. But Joe, you got my calendar link. Feel free to book a meeting with me and be happy to go through your personal situation with you. Now there is one other type of remitter, and this is a quarterly remitter. So if your average monthly withholding amount is less than $3,000, you would be eligible to do a quarterly remittance. But again, here the key here is whether you're monthly or quarterly. If you're only doing an annual remittance, you don't have to pay every single month. You just have to pay in that month in which you are paying your employees, which is only once per year. You just need to fill in that PD7A form to tell them that you don't have any eligible employees with any eligible remittances for those other months. Lastly, I do want to take a quick mention of associated corporations. So some of our clients do have holding companies where they might be issuing salary from both companies. And your average monthly withholding amount is the combined average monthly withholding amount of the two corporations. So just be aware of that, that could push you into a different threshold. But again, if you go by our most conservative option, you will be safe. But that is definitely something that is important to be aware of, these deadlines, because the penalties can be quite large, and we'll talk about those penalties in just a second. As I mentioned earlier, if this is your first year of operations, you will be considered a regular remitter. If you were incorporated by us, we will have set up your business number, and we will have set up your GST, HST account and your corporate tax account. We will have not set up your CRA or your payroll account with CRA, simply because you would have been getting notifications every single month saying, hey, where's your payroll remittance? And usually it's not required, because your payroll account will be created automatically as soon as you go online and make a payroll remittance. Now, if you want to receive a physical PD7A form, and we're going to talk about that form again in more detail later, which is required if you're paying in person at your bank, or sending it by through Canada Post, then you will need that physical remitting voucher. And that is something that is mailed to you by CRA. It's not something that we can send to you because it's specific to your company. And you will need to go onto CRA's website or call CRA to set up a payroll account number. And then this will be mailed to you shortly thereafter. Now, for paying your remittance, there are a couple of different options. My number one recommendation is online banking. In different banks, it's in different sections. It's usually under Pay My Bills or similar area, but it's typically under a separate section called Pay My Taxes. And then you'll go in there and you'll look for federal taxes, payroll, and you're usually looking for something that says PD7A. And that's going to ask you for a couple of pieces of information. It's going to want to know your gross payroll, your number of employees, and the payroll remittance amount you're making, as well as the month in which the payroll was paid. So that would be typically, December 31st. And in fact, they don't even ask the date, they just ask the month and the year. The same information will be required if you're going through the My Payment site on CRA, or the My CRA account with My Payment. The thing to be aware of here is that you can pay by debit card, which is Interac, which is typically going to be limited to a maximum per day of $3,000. There are some MasterCard options, but these do charge a processing fee. That processing fee is going to be greater than any points that you get. Even if you have an Amex points card with some great systems, it's going to cost you more in fees than you'll get in points. So for those of you who are thinking, hey, this will be a great way to earn some points from my credit card, I do not recommend it. You can also do pre-authorized debit. You can pay by credit card, PayPal, or Interac. Again, this is going to be through the CRA My Payment section. You can pay by check by sending a payment in the mail at Canada Post. The key here is that you are going to need a copy of your PD7A form when you go to Canada Post. It will be considered to be paid the date you drop it off at Canada Post. That's a nice thing. In addition, you can pay at your financial institution. Again, you will need a PD7A form if you're going to either your financial institution or Canada Post. And in both of those situations, it will be considered to be paid the date that you go to either Canada Post or your financial institution. But like I said, you got to have that form so that they can stamp it and mark it as complete. Now, if you are late, the penalties for source deductions are the highest of any tax penalty that we have here in Canada. And that's because CRA isn't looking at this as a small business owner who's paying themselves. they're looking at this as a small business owner who has taken money from their employees, who are typically at arm's length, taking money off their paycheck and are holding on to it, and they're supposed to remit it to the government. And if they don't remit it to the government, this money that you've held in trust has gone awry, and they take it quite seriously. So if you're even a day late, there is going to be, and there will always be, a 10% penalty. And if you have either gross negligence or you fail to deduct the required amount for more than one calendar year, there is a additional penalty of up to 20% for second or third or fourth or fifth late remittances. So really, really important not to be late on your payroll deductions. If you are struggling with a cash flow, I would consider either looking at a dividend or just covering the minimum CPP. Now, with a salary remittance, an employee is allowed to tell their employer that they have things like RSPs or childcare deductions or other deductions that would mean that they're not going to have to pay the full tax rate when they file their tax return, and therefore they don't want their employer to withhold the taxes. Now, the employer must always withhold the CPP and EI if it's applicable. But if the employer has if the employee has told the employer not to withhold the employee or the income taxes, then they can not do that and only remit the CPP and EI. So if you're struggling with cash flow, you need to make sure that you remit at least both the employer and employee portion of CPP. And at the end of the year, we will prepare a T4. Well, at the end of February, we'll prepare a T4, send it to the government, and we will tell them that you have withheld just the CPP. And when the employee goes to file their personal tax returns, they'll have the CPP that has been withheld and remitted and paid. But if their deductions that they have on their personal tax return aren't enough to wipe out all of their income tax, they will have to pay some additional income taxes. Now, on the flip side of that, if you had estimated too high and you had over remitted, then you will get a tax refund when you file your personal tax return. And this is why our recommendation when you have either under remitted or over remitted is to simply adjust the T4, provided the under remittance still covers the minimum CPP. If you haven't covered the minimum CPP, you do need to pay that as soon as you can, and there will be a late penalty for any portion you did not pay. Now, if you have made a payment and it has gone to the wrong account, maybe it went to corporate tax or GST instead of payroll, the good news is that is easily fixable by contacting the CRA. It can be done through the CRA portal to reallocate a payment, or it can be done with a phone call. The good news is that CRA will consider that the payment is made the date that the payment was made, not the date the payment was transferred back to the appropriate place. So if it went into the wrong account, sat there for a month, you won't be considered late just because it didn't get transferred to payroll until a month later. It will still have been considered paid the date you made the actual payment. So hopefully that's pretty straightforward. Now, your next steps, if you are a client of ours, is to complete the personal tax planning form or book a call to discuss your tax planning with your account manager here at CPA4IT. The personal tax planning form is a form designed to make it a little bit faster and easier for you and your accountant to work through the tax planning. I will show you a copy of what that tax planning form looks like. If I can find it. Here we are. So this is what the tax planning worksheet looks like. Many of these fields, if you are, this was sent out to you as part of the source deduction campaign that many of you received, which is why you logged into this webinar. So if you have completed this form in the past, the form will remember that information. So it will have your company name and your email already in here. You do need to tell us whether you want us to prepare a T4, which is for salary, or a T5, or if you're going to be preparing it yourself. So if you could just please go ahead and select that. We will be reaching back out closer to February. If you've told us no, or if you've told us yes, but we don't have any tax planning, we'll let you know. A new question that is very, very important for us to answer is whether you have any dental care insurance or coverage. This is a new field that was added last year to the T4s. And that's because of the new federal dental coverage payment plan. So we do need to know if you have an insurance program within your company, and if that covers dental, and if so, does it cover just you? Does it cover you, your spouse, and your children? Does it cover just you and your spouse? Does it cover just you and your dependent children? So we do need that answered. Again, if we're preparing your T4 and you don't answer it here, we will be reaching out again closer to T4 season. And again, the next questions are, again, helping us to figure out what we want to do as far as tax planning. So how much money did your business earn from a gross revenue standpoint? How much money did you spend on business related expenses paid personally by your personal account, not your corporate credit cards or corporate bank account? And then how much did you spend through your corporate bank account and corporate credit card? And then how much did you take out of your business in form of director's advances? And how much has your company already paid toward 2024 payroll taxes? And how much money did you take out of your company for either the purchase of a home or a car, which can be used as a home loan or an auto loan? Based on that, we'll be able to go in and do some tax planning for you. We will send out a draft. If you're happy with that, we're good to go. If not, we can book a review meeting with your account manager to go through it and revise it. We will ask for some additional personal information about you and your family. Again, this is going to come down to income splitting and tax planning strategies for you. Once you've completed this form, give us a couple days because we are dealing with 700 clients. So we do tend to get these in mass. You'll get an email back from your team with a recommended tax planning and source deduction remitting amount. If you have any questions about that and want to go through it, please feel free to book a consultation with your account manager. In addition, if you find this overwhelming and can't complete the form, you do not have to complete the form. You can just reach out and book a meeting with your account manager, and they will go through with you to do your tax planning. And then once you have received your plan, you obviously want to go and schedule your remittance. And what I do highly recommend is the number one way to do it is through your online banking, and you can actually schedule that payment to come out on the 3rd. That is basically my long-winded session on payroll source deduction remittances. I want to thank you guys who joined me today. And again, if you are not a existing client, feel free to book an initial consultation with our team members. We'll be happy to tell you a little bit more about our services and how we help clients organize their finances, create wealth, and transform wealth into a legacy. You can find that link on our website at cpa4it.ca. And again, I want to open it up for Q&A here and thank everyone for joining us. And if there's no questions, I'll just give you back some of your time. Awesome. Okay, I see most people are logging out. So I'll assume there's no further questions, and thank you, everyone. Have a great day.